Dutch financial services provider Aegon has reported a better than expected first quarter operating result of 431 million euros. The company says the 20% growth was driven by improvements in its home market, the US and its asset management division. Joining us now is Lard Friese, who is the CEO of Aegon. Lard, thank you so much for joining us today. Let's just get into some of the strength cited in particular has been the impact of cost cutting and a strong performance by stock market investments. It doesn't feel as though both can continue forever. So just give us a sense of the strength you're witnessing and what comes next.
Well, good morning to you. We are very pleased to report the quarter today. It is a good progress, the first signs of good progress of the transformation journey that Aegon has set itself out to from the Capital Markets Day in December recently. So we're off to a good start of the year. Indeed, operating earnings up 20%, a good progress made towards our cost reduction target of 400 million by the end of 2023. And we've reported today we've done 136 million of that. And we're seeing also commercial momentum building in our strategic assets. So we're off to a good start for the year.
You're the third company we've spoken to in the sector today, and what's jumping out has been the impact of low interest rates, but then that being offset by better pricing mix and inflows coming into the sector. If we do start to see some form of tapering, this extraordinary monetary policy tackled by central bankers, what does the next phase look like for your sector?
Well, I think the markets are in a discovery phase, I would say. They're trying to discover the post-pandemic world. And as you can witness from the last couple of days, there is some bursts of volatility surrounding that discovery process. Now, the fear of inflation is one. If inflation, however, translates into higher interest rates, that is good for our business. It is good for our products. It makes our products more attractive for our customers. And it also increases capital generation. So when inflation rates would translate into higher rates, that is good for us.
Can I ask you about the ongoing restructuring program? I know that you delivered a very solid statement to investors back in December here, but how far down the road are you on the program, and do you think that you will need to take out further costs here as you seek to improve operational leverage?
We have decided we have disclosed at the Capital Markets Day in December what our focus will be in the coming years for the perimeter of the company. And they will be in our core markets, which is the US, the UK, the Netherlands, and then growth markets, Spain, Brazil, and China, and then the global asset manager which connects the dots in all these businesses. All the remaining other businesses and ventures, we're running tight capital and with a bias to exit them over time. As part of that journey, we have announced today that we have that we have closed the Stonebridge divestment and that we have divested Transamerica's venture fund in the United States. And obviously, we're also still in the process of closing the divestment transaction in Central and Eastern Europe and Turkey.
Yeah, obviously, all of this helps put money back into the piggy bank. Even as you're making disposals, though, and you are reshaping the portfolio, is there anything out there that you see that it would be worth adding as opposed to selling? M&A may come back to the equity story as time progresses, but we are at very early stages of that. So we are really focused fully on executing the plan that we have announced at the Capital Markets Day. So at this point, M&A is not a priority for us.
I was reading a bit about your strategic assets, Lard. Good morning to you. And it's the ones where you see potential good return on capital as well. What is your return on capital at the moment in the round, and what do you think you can get it to in the short term?
Yeah, so it's our return on equity is roughly a little bit lower than 9%, 8.9%, 8.8%, and we aim to, of course, grow that. But to us, the most important metric is the capital that we generate and the free cash flow that we derive from that. And for the strategic assets which we aim to grow and expand, obviously we're looking at metrics like sales growth, the profitability of that sales, and then depending, of course, on the particular business line and the particular product set that we're talking about. But that's where our focus is.
Lard, I mean, look, it's great compared to many institutions out there, but we've just spoken to Allianz's CFO, and they've got a 16 handle on their return on equity. There's a bit of a gap there, sir.
Well, as I said, Aegon has embarked upon a fundamental transformation journey. We have launched our plan in December of last year. The first quarter that we're reporting now is showing good signs of early progress that we're making on the execution of our plan. There's a lot of work ahead of us, but this is a good start of the year.
You need a bit of help from the central banks to make money more expensive. Otherwise, everybody's fighting over the same pot, and you get all these tourists coming into your business thinking they can do it for lower premiums. Do you need some central bank action to just kind of get some real rates again?
Well, I'm not in the room of the central banks, right? I'm just a manager of a business, a leader of a business that navigates through the entire economic environment. As I said, the interest rates are low. They have come up in the United States a bit, in Europe also a little bit, but let's face it, also historically, they're still very low. Now, as the pandemic slowly but surely gets behind us, and we can see the post-pandemic economic outlook, let's hope for rates to go up, which will be positive to our business. In the meantime, we know how to manage through a low-rate environment. We've adapted our balance sheets to ensure that at all times, the money of our customers is safe.
So just to confirm, if you say rates going up will improve your business, at the moment, low rates and negative rates are detrimental to your business, sir?
Low rates have been with us now for a number of years already. We know how to navigate through that, as is demonstrated by the strength of our balance sheets and the way we operate the company. And we have, rates up are better for the entire sector, also better for us. But we know how to navigate through this. We've adapted our balance sheet to it to ensure that our customers' money is safe at all times.
You're a stunningly busy man today, so we never, ever don't appreciate the time you give us. So thank you very much indeed for that today, sir. Thank you for taking all our questions. Lard Friese, who is the CEO of Aegon.